Hello everybody, Casey here, Brick by Brick Wealth. Today we're going to talk with Danielle Anderson at Waterstone Mortgage. I really like her. She's been really great to my students. She is a loan officer. She also is a real estate investor herself. And I have a lot of questions for her. We've discussed what we're going to talk about. So if you guys are wondering whether you should buy now or wait, there's so much going on right now in the economy. She is going to help us with her forecast and the information that she has found through, through her work being a lender and all that and what she's saying. We're going to get some answers today. So this is definitely a must watch. If you guys cannot stay to the end, I'm going to post it to my feed. So you'll be able to watch the replay, fast forward to any parts. And for those of you who are just getting started with real estate investing, you guys know, you may not know, but I have a free guide to get started with real estate investing that you can get on my website, brickbybrickwealth.com. Also, there's a link in my bio. It's called Retired 9 to 5 with Real Estate. It's a free online course, really popular among everyone. So if you are just now starting to follow me and you haven't taken that yet, please head over and do that. It'll also put you on my weekly VIP newsletter that I send out to all of my wonderful people who want to hear from me once a week. I send special emails and information to you guys more than what's offered on Instagram. So Danielle, go ahead and push the little plus button down there, the video, and we will get you on. So again, if you guys are just joining us, we are going to be speaking with Danielle at Waterstone Mortgage and asking her all the questions about whether you should buy now or wait, what's happening in the economy with interest rates, what's the forecast, are prices going to go up or down? I know that's really being talked about right now, so we are going to get a take from a professional. So here we go. Let's get any questions. You can put them in the comment. We're going to cap this to 45 minutes today. So here we go. All right. Hi, Danielle.
Hi, Casey. How are you doing?
Doing good. How are you?
Doing great. Just here in snowy Colorado and Frisco. We got our first snow this season, so.
Alrighty. What is it? Almost end of October.
Yeah. So thanks for having me on. I'm happy to chat with your students and anybody else that's interested in real estate investing on what's happening in the economy, what's happening in the market. Is now a good time to buy, or should people be waiting, etc.
Yeah, so for those of you who don't know, Danielle is a loan officer and she's an investor too. So she definitely can help you guys. You do short-term rentals is what, I'm pretty sure, right? So
yeah, yep, short-term rentals, and I have I kind of mix short-term rentals and long-term rentals. So yeah.
So you guys can always reach out to Danielle if you have any mortgage questions through Instagram, and she can give you her contact information. And if you're looking for a loan officer, she's great. I recommend her to all of my students, and everyone is always very happy. Oh, I love Danielle. So just, everyone says great things.
Perfect.
Okay, so I have, I know we discussed a little bit before what we're going to talk about. So I'm going to kind of guide what I think is important. First thing I want to know is, what's today's rate for just a great investor with a good credit score? What would their rate be today for an investor loan?
Yep, we're looking about 7.25%. And every rate right now pretty much has points. So points, the best way that I describe it is points are upfront interest. And with an investment property loan, you're getting hit with something called loan level price adjustments. And loan level price adjustments aren't something that your lender's putting on. It's really coming directly from the investor. If you're doing a conventional mortgage, it's getting sold to something called Fannie Mae or Freddie Mac. And 80% of all loans go to those particular investors. And they have guidelines that state all interest rates are based on risk. So if you're buying a primary residence, that's the less risky of a property. So your rate is better, as well as you pay less in points if there are points to be charged on that particular scenario. On an investment property, that's the most likely you're going to default on that loan. If you lose your job, can't pay your mortgage, etc. Typically you get rid of the investment property or don't pay on that before you don't pay on your primary residence, which is kind of the reason why. So right now, and that is if you're putting 25% down. So if we rewind to, I don't know, January of 2022, there was such a thing as a 15% down investment property option to put down. Yeah. That went away when rates went up. So when rates went up, there's something called compliance concerns. So I can only charge up to 5% of for points or
For
including origination
Which,
charges.
which is high because it used to not be 5 points.
Oh, you used to not be able to, like, I used to quote at 15% down with 0 points.
Yeah.
Those rates just don't even exist anymore. And I'm a lender that has the ability to shop multiple lenders, whether it's Chase or Wells Fargo or SunTrust or BB&T or our own portfolio items. And if they're doing an investor property, there's really no rates without points. And I want to go into the reason why behind that. So as a lender, I originate and provide funding at the closing table. Now, there's multiple things that happen on the back end of lending. And that is so mortgages get sold, and I have a product, right? And that right now there's no buyer for the end product of a very high rate. Like so I just quoted 7.25, without a scenario, 800 credit score, whatever. Now, if that rate was 8.5, I wouldn't have anybody to sell that loan to, because what they're thinking, it's something called runoff. And that's going to get really, into the weeds, and I don't want to get that far. But the bottom line is that most economists are thinking that rates are going to decline in the next 12 to 18 months, in which case they're not going to make money off that 8.25 rate, because that's going to get refinanced into a 6.25 rate, or, whatever. And so they're charging that extra point or extra 2 points for upfront interest, which is also why I'm recommending all my investor clients to put 25% down instead of 20% down, because on 20% down, you might be getting charged 3 to 4 points to originate. Well, that's really putting 24% down. So why wouldn't you put 25% down and pay a point versus putting 20% down and paying 4 points? Like, that just doesn't make any sense.
It's sad. 20% down was the gold standard for my whole life. I've been in real estate in some capacity for 15 years, maybe 16. No, I don't know. 15 is a good round number. And it's always 20% down, no points, 20% down, no points. And now I still ask my students, like, you probably get the same, I tell everyone, okay, ask Danielle, ask these certain ones the same questions, you probably hear the same things, but I'll still say, ask the lenders about 20% down anyway, just because.
Yep.
Just so you know, because it's really only been the past year that 25% down has been it. Like once you hear what your rates and terms are for 20% down, you're like, oh, never mind, I'll go 25.
Yeah,
you're like, I'm going to do as much as I can. Well, wait till you hear what your rate and down and points will be.
Exactly. And I'd rather see that go towards principal versus
exactly.
Market.
And that's the thing, is that points, it used to be just buy down your rate, a little bit of points, like less than a half a point, whatever. But now we're talking multiple thousands of dollars, multiple percentages. And like you're saying a minute ago, might as well just put that towards your down payment. Why would you pay that in points?
Exactly.
Doesn't make any sense. Now, 25% down is the standard now. And I don't know if we'll ever really see 20% down again.
I think we will if rates go down. So it's all based on this being sold to the, so as rates go down, mortgages are sold in what's called coupons. And so we're in this like threshold of we had such a rapid increase in rates so quickly that's why we're in a points environment. So hopefully we will see points go, come back to like 0 points for an investment property. Which
that would be nice. At least have a baseline of this is the standard. If you want to pay more, you can,
Yeah, exactly.
I have a question. It wasn't on our little list, but a lot of my students, want to buy a short-term rental, a vacation home. And, it was, you could, the perks for going second home / vacation home was that you could get an owner-occupied interest rate. You could put 10% down, 15% down. I know things have changed, so most people watching may not even know that. So what has changed now if you're looking to get a short-term rental or, a vacation home / second home loan? How is that different now than earlier this year?
In March of 2022, going back to the same investors, Fannie Mae and Freddie Mac, which are conventional loan mortgages, they put in those LLPAs, loan level price adjustments. A second home versus the primary residence used to be the same loan level price adjustments. So you'd have adjustments for credit score, but you wouldn't have adjustments for occupancy type. Then they changed that this year. And so a second home is really the same rate as an investment property for conventional. However, because I specialize in that second home environment, there's still some loan options at 10% down for a second home if they're short-term renting it. If they have to plan to use it as a vacation. If they offset their mortgage by short-term renting it, yeah, they can't go into it as an investment is what I'm trying to say.
Right.
But the qualifications is you have to qualify with both your current home mortgage plus the new home mortgage. You can't use any rental income to offset the debt to income ratio on a second home, which would be a major difference.
So you still can put 10% down and get a second home. And do you still get the owner occupied interest rate?
No, there's still, so it's all portfolio now. So we are now talking non-conventional loans. So each lender could have their own. Here at Waterstone, we have one particular 10% down second home, but it truly needs to be a second home. It needs to be 60 miles away from the primary residence, or it needs to be in a resort town. They're planning to use it with their family, that kind of thing. And the only reason that we're talking short-term rental is just they might short-term rent it to offset their mortgage at some point through the process. Yeah.
Right. So traditionally, like for a conventional conforming loan, are those still offered at below 20% down with owner occupied rates?
No, you're in the same challenge with points with 20. Yeah.
So they don't have, so that's what changed in March is Fannie and Freddie said no more vacation homes.
Exactly. Yep.
Now it's all,
unless you're with a portfolio lender that has different guidelines.
Right, unless it's lender specific. And do they have to hold that loan in their portfolio and they can't sell it to the government?
Correct. They can sell it to other investors, but they're typically holding it in-house. Yep. They've decided like, oh, we'll do this, and typically the guidelines are much stricter. Like I need 12 months of reserves. I need the debt to income ratio is 40% instead of 49. So there's definitely different guidelines that need to be met and that's investor specific guidelines. You're only selling to one person. So the bank can kind of say like, I like you or don't.
Exactly. So that is what changed is that before Fannie and Freddie had a second home loan type, correct?
Correct. Yeah. And it was very similar to a primary and it was much cheaper financing. And that would be typically what most people would do is buy their second home that they plan on using it. Like you can't commit mortgage fraud and and do an investment property and say it's a second home. It truly needs to be a second home.
But that's gone now. Fannie and Freddie said no more
for everybody. Yep.
Yeah. So now if they want to do that and they want it to be conforming, it's not. It has to be an investor loan. So you're getting, right?
Correct. So it can still be conforming. Like I can still do second homes at 500,000 or 200,000 or whatnot.
Right, but that's you and your company. That's not.
It's portfolio based. Yeah. It's every single lender will have their own.
Okay. So those of you that are listening, if you want to do short-term rental, midterm rental, whatever, or, vacation home, you can't get the owner occupied interest rate and have it be a government-backed loan anymore. Now you have to go lender to lender to see what programs they offer for that.
Yep.
All right.
And there's not many lenders that have 10% down. That's like
no, I haven't found one of those. And if they are, they're like rates, their terms are not.
Yes. So yeah, we have one at 10% down up to like 1.5 million. And our terms are still pretty good, but it's an ARM. So it's an adjustable rate mortgage versus a 30-year fix. We don't even offer a 30-year fix, which in this market, I love ARMs. Because all the economists that we're looking at, our rates are going to decline in the next 12 to 18 months. So who cares? Your rate's locked in for 5 years. Now, when we're going back to investments, which I know a lot of your clients are, a lot of the investment, there's not really good programs for investment ARMs, but there's great programs for second homeowner ARMs.
Yeah. Okay. Good to know. Everybody hear that.
Yeah.
So, all right. What else can I ask you? Okay. So let's talk about best time to buy. And I know it's probably cliche. Everyone's not talking about best time to buy, but I have so many people that I talk to all the time on Instagram, students that are still like, should I wait till spring? Should I just put everything on hold? Should I wait? And, everything that I have said for all other years about the winter being the best time, it still holds true. And to me, it still holds true double. Like today, this winter is special. This winter to me is unlike any other winter that we've had in the past 10 plus years. And that's because of where we're at with the economy and the fluctuation and people freaking out.
Yep.
Wouldn't you agree?
I would totally agree. So what's interesting, and a mentor of mine way long time ago told me like the best time to buy is when nobody's buying.
Yeah.
And right now, not a lot of people are buying, which your demand has declined. Our supply is kind of flattening. Now, historically, across the country, between October and January is historical months of good months. Why? It's because who wants to list their house during Thanksgiving,
Right.
during Christmas, during New Year's, like unless you have to. So we call those motivated sellers. So motivated sellers are somebody that's going through a divorce. Motivated sellers are perhaps there was a death in the family, maybe grandma and grandpa died and they're downsizing. Or maybe it falls into an estate and it's the 3 children that now have this burden of this probate and like getting rid of the house. So, okay, you come to them with a $10,000 under asking offer, and they don't have an offer. It's been sitting for 90 days. They're more likely to say yes to that. So I always tell my clients, I was like, yes, it sucks. Rates are high. We know that 22-year highs, but there's a thing on Instagram right now and all across the web about divorce rent, marry the house, date the rate.
Yeah.
And here at my company, we're offering a free refinance 6 to 24 months after somebody purchased the home to kind of just like say, and free refinance, free lender fees and free appraisal. I just want to clarify that there's still title charges and stuff with the refinance. But because we think that that interest rates are going to go down. And so as long as it cash flows, it doesn't matter when you buy, especially when we're talking about investment properties. So do you have a stable job? Do you have reserves? Do you have enough cash to put down? And does the property cash flow? Right now is perfect. I was actively looking. I actually went under contract on Monday. Regretfully, I had to get out of contract Thursday because it was my own fault for not doing due diligence. I thought it was zoned properly where I could have a tenant in the basement and short-term rent the upstairs. And apparently the legal side of things is it had to be owner occupied in one of the units. I thought that was ridiculous, but anyway, and I got it for now Colorado home prices are a little bit more expensive than if you're in Ohio or Tennessee or Alabama. So it probably would have been like $650 in the spring. They listed it for $625. They did a price reduction to $595. I was under contract for $589,000. So yes, my rate was more expensive. I got $5,000 in seller concessions that they agreed to, and a purchase price that was significantly lower than if I would have been in the frenzied market in the spring. And as a lender, I have thousands of clients that are pre-approved that are just waiting on that sideline. So what I fear is we're going to get into that frenzied market again as soon as we see a decline in rates. So and then you're going to have the bidding wars again. You're going to have 10 people offering on every one home. You're not going to get an inspection. Like right now, you can negotiate on an inspection. You can negotiate on an appraisal. You can have seller paid closing costs or rate buy downs. So all of those things. So there's opportunity in every market. If people went under contract 8 months ago, amazing. They got a 3.5% rate and they're saving money on interest, but they might have had to go $5,000 over ask or $20,000 over ask to get that house. Now we're seeing the flip side of, okay, interest rates not super favorable, kind of suck. Addressing that. However, there's advantages that because that homes are sitting longer, you're getting a deal on that house in a lot of markets. Yeah.
So I want to touch on, even a little bit deeper on why now is the best time. In the wintertime, historically, October, November, December, January, February, best time is to buy. Just like Danielle was saying. No one wants to move in the wintertime, especially if you're in an area that snows in California. Like, who cares? I'll move in November. Yeah, well, if you're in Indiana, hell no, you are not moving in feet of snow. So that kind of area, those cold areas kind of shut down more in the wintertime. Less people listing their houses, less tenants wanting to move, lease agreements, a lot of lease agreements on the East Coast. They say you cannot get out of your lease like November, December, January, February. Like you have, and I've seen tons of lease agreements and they say that like you have to move only in the summer or spring. So it kind of shuts down. So if people are selling, during the winter, it's because they have to sell. But besides just the weather, people are, because of what happened earlier this year, we had, the beginning of the year, January through end of May, June, it was frenzy, crazy. I bought a house over asking, happy that I did. I still love my property. I wouldn't have gotten that today. The rate, all that is great. Happy with it. But once rates started going up crazily in June, we started seeing significant price drops, right, with property. So the golden spot right now, besides the winter, is the sellers that have that have been on the market, listed, have their properties listed, and
Yep.
either they were overzealous before because they thought I'm going to get whatever I want from my house, so I'm going to list it high, and now they're like, every 2 weeks, every 3 weeks, 4 weeks, and the realtor comes back and says, well, rates went up again, and we're getting closer to winter. You got a triple whammy. One, people are already wanting to sell because they're already feeling, the sellers are freaking out that they missed it, that they missed their chance to sell at the high, so they're listing. Maybe listed a couple months ago, and prices are going down because it's winter. Prices are going down because it's a recession, and the interest rates are going up, so it's reducing their buyer pool. So they're seeing less activity because of that, plus the winter. So because of those factors, which are different, which are extra on top of the cherry on top, besides just being winter, sellers are now more motivated than ever. There are multiple reasons why, if there's a seller right now today with their house still on the market, chances are very good you can get a good deal. So, I mean, even more than the winter. And this is what makes me so excited. Like, for example, I don't know if I will, because I don't know how much I feel like doing it, but we wanted a lake house last year. We wanted a lake house. And last fall, or right before, during fall, I said, you know what, people sell their lake houses, their vacation homes when the season's over. So I waited, I looked, no one sold the freaking house. I'm like, and it was going to be for me too, so I was a bit more picky than it just being like a rental. So we were in contract, whatever, fell out, ended up saying no to all of them. But right now, I'm like, okay, if I really want to go back into it and do the work again and try and find a lake house again, any of those houses that are on the market right now, and it's in a vacation area, like, come on. I know I could get one if I really felt like it. So I don't know if I want to do all that right now or just get a couple more long terms because they're so easy. You know, we have a travel trailer now, so we can do that. So, but it's very tempting, you know, to go into those special markets, the short-term rental markets, the vacation areas, and scoop those up, because those people, also with the recession, people are selling their short-term rentals with 2021 rent rolls. Like, look at our income report. You're going to make $100,000 on your rental next year. And I just want to laugh. It's like, no, you won't. There's a recession. People are making
and I want to put a caveat in there too, especially if people are looking at short-term rentals, is make sure you are looking at the legislation, because some people are changing it because they can't short-term rent their home anymore. So if you like, ordinances are per county, so make sure you're working with somebody and that you do your own due diligence on short-term rental regulations, because that's the #1 reason people mess up on the property purchase. Is it's like, oh, the previous people rented it, I can rent it. It's like, no, they could have illegally been renting it, or they got shut down, or
and that, I mean, that's part of due diligence. I mean, and if you're not doing that, it's like, you know, that's like the
that's
biggest
why they need to use
no. You have to check, you know, check the city, the county, you know, there's new rules where we wanted to initially buy a lake house last year was in Hot Springs, Arkansas. It's 3 hours from us. I love it because it's a year-round destination. It's got a beautiful downtown. People go for bachelorette parties, fancy dining, like cool things to do. There's a water park. There's year-round camping. There's year-round stuff. So it's not like I would just be renting my lake house in the summer, which is why I liked it. But the city has gotten so many short-term rentals that last summer, it was in May, and I was still going to buy there and get in. They put a cap on how many short-term rentals, and you have to apply, and you have to reapply every year. So it's like, I was like, okay, well, I don't want to buy in the city anymore because it's a shit show. And who knows what's going to happen if you have to get reapproved every year. Like, what if they say no?
Yeah, but that's normal, actually, Casey. And typically you get a renewal as long as you don't mess something up. So you do have to make sure that you're paying your taxes, that you're not getting a lot of noise complaints, you know, so all of those sorts of things.
But it's just so risky. You know, and a lot of people too, you know, short-term rentals are usually in nicer areas. So you're not going to be in a long-term rental neighborhood with a low mortgage payment. It's, for a lot of people, they buy their short-term rental, it's more than their own house. You know,
mine is.
Yeah, because people like, one house a while back, and the new one is like, oh, it's pretty expensive, you know. So are you going to be able to carry that payment through a recession, through what if they change the rules on you? So it's definitely higher risk, you know, higher risk, higher rewards. Steve says, great points. Do you mean Airbnbs? Yes, an Airbnb, a VRBO, those are short-term rentals. Anything rented less than 30 days is a short-term rental. Long-term, more than 30 days. Mid-term, more than 30, less than a year.
Exactly, yeah.
But anyway, it's a little risky. I would just be careful. And, you know, another thing, if you are thinking short-term rentals, that is really off topic, but tri-county areas, no HOAs, and like I know in you know Denver area, everything's in an HOA, pretty much. You know, unless you kind of get out towards the mountains, I think, or maybe the older neighborhood.
Yeah, actually the opposite. Mountains are more HOA, and
more mountains are.
I recommend mountain or HOAs in the mountains because they regulate that they already allow short-term rentals, and you have snow removal. You don't want to be paying somebody to snow remove, like having that headache in an HOA, which is completely different than if I was looking at a short-term rental in Denver. I'm completely in agreement with you. Like, yeah, single family residents don't have to deal with it, but most mountain towns, because it's resort, they are designed for short-term rentals and you can't find, like, condos are $1 million. So you can't find a long-term, or I'm sorry, a single family residence for most people's price budget.
I know, I've looked, I know.
Yeah.
Casey's on here too watching, and I know we were talking last week about, you know, if they found a house or whatever they were interested in, but yeah. And the first thing I saw was the long windy street. I'm like, so who's gonna plow that?
Yeah,
He's like,
exactly.
oh, yep. I'm like, okay, this is gonna be you. Yeah. You know, that looks like a half a mile
street. Things to think about.
Yeah. Okay, what else is on my little list here? Okay, yeah, 15 more minutes left. Anything else that I missed? I know you wanted to talk about, Danielle.
No, I think that the bottom line is that there's opportunity in every market. And I think that if you just focus on interest rates, you're going to just do the analysis by paralysis and just be like, now's not a good time to buy, versus saying, okay, yeah, interest rates suck. You know, no hiding that fact, but there's opportunity of price reductions, seller credits, negotiations. And I do still have the opportunity to possibly refinance if rates go down. Now, I would always make a purchase transaction that I can make that monthly payment work today, not counting on a refinance, but knowing that you're not stuck in that payment most likely, that most likely, you know, in the next really year to 5 years, that payment's going to decline.
Yeah, I think for those of you that are looking, that are thinking about getting into real estate and have not done anything yet as far as buying investment properties and are just kind of thinking about it, now is the time to get the education. Actually, it was the time to get education was December. You could buy right now because it's the next time. But if you haven't, get the education now on how to invest, on how to prepare yourself, and you know how to analyze the market, how to understand rehabs and all these things. When you do see a deal, because there's going to be deals from now till March, you know, can you jump in and get one? Or are you waiting too soon to learn how to do everything? You're waiting too long to learn how to do everything. So when a deal presents itself, you won't even know it's a deal. Or two, you won't be ready to pounce on it because you haven't talked to Danielle. You don't understand how to run your numbers. You don't know how much it's going to cost, you know, a house to get fixed up. You have to know all those things, which is, you know, and I'll say, if anyone's thinking about coaching, you guys know I have a coaching program. There's only literally a couple spots left for the winter. Even though I've had seriously 8+ students close on their first rental or get in contract in the past 2 months. Like everything is like just come together for everyone. And it's been easier than ever to get deals closed recently. Like I have students who are doing seller financing deals right now, which they were on the MLS and they're not, you know, people, this is another one, another good opportunity for people that have bought their houses in the beginning of the year. Okay. They maybe put 20% down, let's say 25% down, but they can't afford the mortgage payment. They've lost their job. They're not earning as much, or whatever the situation is they want to sell. They can't because they don't have any equity. They're going to be negative, especially if they have to pay a real estate agent 6%. So those people that at least have put 20% down and bought earlier this year, and you see them on the MLS, and you can easily find them because you just go to price history, and if it's sold this year, well, then there's one of them. Now, the only thing you don't know is how much they put down, and at least your realtor can tell you if it was FHA or conventional, or cash. They'll know at least that. They won't know the percentage because you can find that on the MLS. But those people will be really good targets for seller financing deals, or, I say seller financing, doing wrap mortgages, because they cannot really pay their realtor. They're already doing this to break even, just to get out. So they may be open to other types of financing options. And a lot of people think, oh, I have to cold call, I have to get deals, off-market leads, or to get a great buy, I have to, do all this legwork. Yeah, usually you do. But like right now, you can find people that bought now and their prices have dropped and their rates are high. So people are not buying. They need to get out and they can't sell for a profit. So there's other things, you can do with those types of people now. Just for anyone who's listening who's looking for another.
Yeah, I know nothing about that kind of thing, but
yeah, it's like, how can you find good deals, and that's what the students run into. But, I will say my students are getting below ask offers accepted. They're absolutely getting their 2% back in seller credits, which is what you can ask for an investor loan. And they're getting sellers that pay for repairs too, So, and negotiating
you did
more
not get 8 months ago. Yeah.
No.
Yeah.
No. So, now is definitely the time to buy. So if any of you guys are, haven't gotten pre-qualified or maybe you don't even know if maybe you're thinking I'm not qualified. Call Danielle. You won't know. You won't know unless you talk to somebody, and there's other things besides, the conventional loans.
What's interesting when we talk about rates, like a lot of your clients are in that really 100 to 200 max purchase price range. Yeah. So when we're talking about an interest rate, you're talking about minimal numbers. Like on a $100,000 loan, you're looking at maybe $9 a month of a difference in an eighth of a point of an interest rate. So if that's going to make or break your numbers, then you shouldn't be buying that property anyway. It's kind of what I'm telling clients. Like that's, so just keeping that in mind. If you're buying a $400,000 or you have a $400,000 mortgage, obviously that 1/4% or that eighth of a point in interest rate is going to make a bigger difference than if it's a $85,000 to $100,000 mortgage.
Right. Well, like rates were, 5.5 a few months ago, you could get, or 6% for investors, and now they're like 7.5. It's like, It makes a difference the higher up in price range, but you're right. Properties are going to be anywhere for my students who, if you're looking for, not even for me, for anyone looking for a long-term rental, you're going to be getting something no more than like right now, $200,000 because around the country, I know lots of markets, it won't cash flow, So now that's single family or duplex. Now, if you can find a great triplex or fourplex, but it's $200,000, you're probably not getting a quality property.
Yes, you're
so though, the
right.
more doors, the more they're going to cost. But as far as like, a duplex or single family, if you're looking for it to cash flow, it's going to be under that threshold. But I'll say one thing, people come into an issue with is the minimum loan amount that lenders will lend on. So like Wells Fargo and such, they can do, there's no minimum really. I mean, like
we don't have a minimum either unless it's a DSCR loan, in which case it's brokered and their minimum is a $100,000 loan amount. And something to keep in mind, for DSCR, for anybody that doesn't know what a DSCR loan is debt service covered ratio. So we're only going that direction if they can't qualify for conventional, because typically you're paying a higher interest rate, more points. Sometimes you have prepayment penalties, etc. But an interesting item to note is you have to have owned a property for most DSCR programs. Like I don't have any broker items or outlets for somebody that hasn't already owned property. So people that are trying to get into investing, but before they buy their own property, it gets a little tricky.
Yeah. You just got to seek out those other lenders, that can do the more riskier loans, but they are going to charge you more. If you've never owned a property before and your credit score maybe isn't that good, and you don't have a job, but you have money, there is hope for you. You can get loans somewhere. It's just not going to be but don't cry about it when they say it's going to be 9% interest.
Yes, exactly.
Yep. It's that's what you get. That's what you get for no job.
Yeah.
But
I love the house hacking. Like I love if you can live in a market where you buy in a market where like the property that I was interested in, where it has a lock off basement. In Denver, you can generate about $2,000 for a basement lock off, maybe like $1,500 to $2,000 and you live upstairs. I love helping for, like, I call it amateur investing, which is how I got into the industry that I'm in and doing what I do is just from accidentally investing like that.
Yeah, house hacking is great if you're wanting to get started because you can do owner-occupied loans, and it's kind of the best of both worlds. A good entry level, you get to practice landlording, and all the things. So it's a great way. But I do know that some places, depending on where you live, that choice isn't there for you unless you want to share your actual house. Yeah, it's not for everybody,
Yeah, it is not for everybody. Yeah. I'm one of the, so I'm like, strangers, come on in.
But you have a basement, like you could lock it off. You can have a separate.
Actually, technically, they could walk up my stairs into my house.
I can.
I'm working on a door because my profitability would be much greater. And to be honest, since I only do it when I'm like I actually had guests this weekend when I was gone. So I did my basement when I was gone, but technically they don't have access to upstairs, but if they wanted to get there, they could. But I've done it for 10 years, no issues, and
that's sweet. Yeah,
I like finance my next one.
I know. I'm with you, man. If I didn't have 3 kids and I had a basement, I would maybe do that too.
Yeah.
Anyways, thank you so much, Danielle, for doing this live with me. We'll do another one soon. If anyone has any questions about what we talked about, the replay is going to be on my feed. I don't know if Danielle put it on her feed too. We'll see if she likes my cover page or not.
Yeah, I love it. Yeah.
All right, cool. And if you guys have any questions, either of us, we respond to DMs. So thank you very much, Danielle, and I will see you next time.
All right. Sounds great. See you, Casey.
Bye.